Oh, hi, everybody. This is Josh Jalinski, the financial quarterback, and joined by one of my favorite guests, David Ranson, who's going to be talking about infrastructure spending and what it means for the economy, gold, and how it may protect you from inflation. Are we headed for inflation, deflation, and more? So, David, talk to us about your background and a little bit about what brought you into finance for our listeners who've not heard you before.
Okay, yes. You can tell I'm English. I've been in the United States for two-thirds of my life. But I went to college in England, and my original field was chemistry. So I'm kind of scientifically trained originally. And that produces a little bit of a culture shock when I hit economics. I came over to the U.S. to go to business school, University of Chicago, and I met economics really for the first time, and I found it made sense. What the little bit of economics I'd learned in England made no sense to me whatever, and I stayed away from economics. Same thing with finance, which I view as a major branch of economics too. So from 1965 to the present, I've been over here and practicing some form of economics or finance.
So what was when you studied in Europe, what was the prevailing school that you were brought up in, like Keynesian economics? And when you went to Chicago, it was more Hayek and some of those things?
Yes, that's pretty precise. As I say, I stayed away from it in England, but if I had studied it, I would have found that it was virtually entirely Keynesian. Keynes' followers had pretty much taken over all the British universities by the 1950s. I suppose some of the older economists held on until they died, but they're all gone now. And it's very hard, I think, to get a job in an English university or a British university with a classical background, such as the one that Chicago taught me.
So you got to be, I guess, if Keynes, and is it a national thing? Where's Keynes from?
Oh, Keynes is English from the south of England.
So do you think it's a national pride? We have to go for.
Sorry?
Was it a national pride thing? We got to go with the Brit, or no? He was just the prevailing thought.
They were pioneering in the 1930s, but not in a good sense. I think they were pioneering with a very bad idea, which was that we could rely on the government to solve our economic problems. And that was Keynes's idea from the very beginning. Keynes was the son of a mathematician at the University of Cambridge, and Keynes himself taught at Cambridge nearly all of his life. And so he had a little bit of a mathematical background himself. But he didn't do mathematical economics the way we have it today. He had some fairly deep ideas, which I think have turned out to be dead wrong. But they persuaded a lot of people because in the 1930s, everybody knew something was profoundly wrong with the economy, and they were looking for solutions. And most particularly, they were looking for solutions that were politically correct at the time.
And so what brought you to Hayek and the Chicago way of thinking? Did you just go there? So what did you go there for, your PhD or master's degree?
Well, I did go for, I needed money. I didn't have any money of my own. My father didn't give me anything. So I joined the PhD program where there was some financing. And in fact, I actually ended up getting a PhD. It took a few years.
From Chicago or somewhere else?
Chicago, yeah.
So what brought you over to the Hayek school? And for those who don't understand what Keynesian economics is, if your eyes glaze over, give a definition of the Keynesian school versus the Hayek school, because people don't realize like these two main forces sort of, I guess Keynes more shapes current policy than anybody else. So we should know about them, right?
Oh, yes. They couldn't be more different. They're totally at opposite ends of the spectrum. The Keynesian view is that the government can or should control the economy, and it should fine-tune it. And it has the Keynesian belief is that it has the power to do so, and that we require a pretty large infiltration, you could call it, of the government into our lives, and it's a price we should pay, and we'll all be better off as a result. The Hayekian view is that the economy is, this is the way I put it in my language, the economy is like a living system. It is not driven from any central authority. It's a system that collectively drives itself and makes its own choices, because it's made up of individuals, but no single individual dominates the choices. The choices come from the huge numbers of individuals all competing with each other. So it's like a system in many scientific disciplines. Biology, for example, the best analogy would be the human body. I use it a lot when I'm talking about this topic. The human body fixes itself when it has problems. Now, admittedly, there are some problems that can occur that require surgery. But all surgeons know that once they've done their job as surgeons, there's nothing much more they can do. The body has to repair itself. And everybody pretty much realizes and knows that the body does repair itself. We see it in our everyday lives. We see it happening. And that's the kind of system that is self-repairing. And I believe many other systems in other sciences behave the same way. The system has its own opinion or its own sense of direction. It has its own repair mechanism, and it does not go along with attempts to control it. I think this is true of chemical systems, with which I was very familiar, and physics and astronomy and many other systems.
So now on to, Keynesian, more government-led, Hayek, the economy will kind of cleanse itself through these boom and bust cycles. Would that be a good summation?
Well, I'm not sure how far Hayek would go, but I would go further than that. I would say we won't have a boom and bust cycle if the government doesn't interfere in the first place. A lot of the troubles we have with the economy arise from the government applying the wrong medicine, trying to control something that is not going to be controlled. So the government will often depreciate the currency, a favorite topic of mine, in the belief that it'll help everybody, give them higher incomes in a sense, but not in a real sense, and that this will preserve some kind of higher standard of living. I think that's entirely fallacious. So the government is constantly trying to intervene, and when you do intervene, you have side effects, collateral damage, or worse, it may be that the policy itself is actively damaging. And I think that is often the case, particularly with Keynesian policies, which require quite a bit of taxation, very large-scale government spending. We've gone beyond anything Keynes dreamed of by now. And regulation, all of these things are supposed to keep the private sector in check, when, in fact, all of the vitality in the economy comes from having the private sector freely make decisions and carry out actions that lead to a better future.
Now, we're talking about infrastructure spending, and for HCWE, which is your company, HC Wainwright, what's the E stand for?
Economics.
Economics, markets, forecasting markets. Your July 19th issue, which, folks, if you want to subscribe to somebody who's exceptional, go to, what is it, hcwe.com? How do people get your work?
Yes, we sell our work to investment managers, family offices, insurance companies, hedge funds sometimes, banks especially, pension funds, and so forth. Our website is hcwe.com. There are examples of our work featured on the website and a telephone number. People can easily reach us, and we provide free of charge samples of our work to answer questions.
Wonderful. And folks, if you want this sample, David's people have been generous to send me a few. We can provide a sample at no charge when you schedule and keep your no obligation review with us at 888-988-JOSH, 888-988-5674. So before we got to take our first break, we're going to be talking about his recent economy watch. Don't rely on a multiplier effect from infrastructure spending. And in that,
Mm-hmm.
David talks about how infrastructure spending does not work the way its advocates say. We're going to talk about that next. And folks, we are live on YouTube, youtube.com. Search for Josh Jalinski, the financial quarterback, and you get to type in any question you have. And we're going to talk about the trade-off between federal spending and private spending when we return. This is Josh Jalinski, the financial quarterback. Don't touch that dial. And we're back with David Ranson of H.C. Wainwright, former assistant to then Secretary of the Treasury, William Simon. So, David, Dr. Ranson, what do you think? Will this infrastructure spending do any good first? And then we'll talk more about your thesis in your article.
Well, yes, infrastructure spending is something the economy needs. The question beyond that is, could we do it a lot better and a lot cheaper another way? The question is whether the government really knows enough to be able to choose the right way to spend the money in such a way that the economy benefits the most. And you can measure whether this is true or not true by looking at a long history of infrastructure spending. Actually, I look at total government spending, not merely on infrastructure, but there are many other forms of government spending which the same things can be said about them. Armaments is a major part of the government's expenditure, unfortunately, and is always going to be true. And the cost of running the civil service, all of these things are called public goods. So the government's total production of public goods includes, as a very major part of it, infrastructure, and it's the part that the politicians turn to when they want to do something in a hurry.
So how would you best prescribe, if you were a consultant to President Biden, have they called you? First question. And second, if they did call you, what would you tell them? How best to spend on infrastructure?
Well, of course they haven't called me. They don't know I exist. And I'd be very surprised if anybody in Washington anymore knows I exist. Although I worked there many years ago as a young person, I wasn't a major figure or anything like that. But if they did call me, if somebody did call me from Washington, I would tell them the same thing I'm trying to tell you, that infrastructure spending is not an efficient way to get the economy moving. Quite the opposite. What it's doing is taking away, you could call it job opportunities or project opportunities from the private business sector, and making everybody or all of these projects into federal projects. And of course, they're directed towards uses of resources which do the most political good for the people who are looking to use them. They're not designed to maximize the benefit to the economy. So there's a very different mix in infrastructure spending when it's conducted by the government from what it might be if the private sector, which is perfectly well able to produce infrastructure, were to do it on its own in ideally in a competitive fashion.
Yeah, I mean, part of me, I drive, we live in New Jersey, and I drive on one of these infrastructure programs that was spent by the 2009 stimulus. What was that called? The Bridge to Nowhere in Alaska? There are bridges to nowhere in New Jersey. Now,
even in New Jersey,
shovel-ready projects. So driving from where I live down to beautiful Ocean City, New Jersey, or Cape May, New Jersey, to see some beautiful Victorian homes, wonderful place in New Jersey if you've never been there. Something like in a time warp.
Cape May is a nice place. I have been there.
And so when you were driving, they had this bridge. The bridge took them maybe 8 years to spend. It was part of these shovel-ready projects. So I was thinking, what are they going to do to this bridge? Are they going to widen a lane? That would be nice, so there wouldn't be traffic jams in the summer going to the Jersey Shore. They did nothing. They put stamps of seagulls on this walk, and they created like a path. No one walks on the path. It's on the parkway. It would be akin to like putting it on a major highway. No one's walking on this path. But it cost millions and millions of dollars. So the shovel-ready projects of the 0809 stimulus were an absolute pile of garbage. I mean, you would have thought with all of the money that they spent, it would redo the crumbling infrastructure, the Holland Tunnel, the Lincoln Tunnel. They would make that tunnel between New Jersey and New York. They did none of the things that were necessary. And I don't trust the government as a good spender. So I would agree with you. But is there any hope, or is this 3.5 trillion, they're going to hash it down to 1.9 trillion, and basically 1.9 trillion dollars is going to be pissed away and no one's better off for it? Is there any hope? Give us some hope.
Well, the hope lies in democracy, actually. The more people who are aware of the wastage involved, and the more people who are willing to spend time studying it or transmitting their ideas to still other people, the sooner we'll have some kind of resistance to this absurd level of government spending at a level we've never seen before. But that's not a lot of hope.
No, not a lot of hope. But we'd like to give our listeners some hope, and viewers on YouTube. So folks on YouTube, youtube.com, search for Josh Jalinski. Also, you can hear us on the iHeartRadio app and the Spotify podcast. We're with one of my favorite guests of all time, Dr. David Ranson, who is a hidden gem. A listener turned me on to you, Dr. Ranson, and he said, you got to listen to this guy. And
thank you.
You're a real gem. We love having you on the program. My listener friend, actually, who views you as one of his all-time heroes, he had a great question for you. I'll be sure to ask the question he gave me. From Dave, he says, is the inflation rise we see now temporary due to supply chain disruption, or is it permanent? Is inflation temporary, transitory, or of a more lasting nature? Not permanent, but you know what I mean.
Yeah, I think it has nothing to do with supply chain disruptions. Inflation comes from a weakening of the demand for dollars. The dollar is a unit of currency, which actually is nothing more than a cipher. It's just a concept. It doesn't have anything built into it at all. And so our whole monetary system is based on it, nevertheless. So public confidence in the dollar is absolutely essential to have our monetary system work properly. And if the government carries out actions which cause public confidence in the monetary system to deteriorate, then they sell dollars rather than buy them. The markets do this for them, and the dollar depreciates relative to any other asset which is more stable. And the best asset to measure this would historically always have been precious metal. And we are seeing a fall in the dollar relative to precious metal recently, but it's not a tremendous, it's going both ways. It is difficult to tell whether it's permanent or sustained or not. We can't measure it very precisely. We can't use the price of gold that is well known because gold is a safe haven investment. And as anxiety about the economy fluctuates, and particularly we've been very anxious, of course, about the pandemic, and we also have anxiety arising from war scares in the Middle East. These things affect the price of gold tremendously, and they're distorting it. But as the pandemic is slowly going away, anxiety is diminishing, and that tends to make the price of gold fall. And this is a misleading signal. The price of gold, the price of a really stable asset would be rising. And the way to measure this is to look at gold or estimate what the price of gold would be in very far forward or futures markets. But that's a technical issue, difficult to describe. But I'm working on it, and it does seem to work.
And what is that? I know you mentioned that on our show last time. Is there a way to summarize that in plain English quickly?
Well, take the oil industry as a parallel. When you buy and sell oil as a businessman, you're very rarely buying and selling the actual commodity. You go to the futures market instead, and you buy a contract to deliver oil that may be consummated maybe 2 years from now. It may be 5 years from now, or even 10 years from now. And so there's a whole price structure for oil quite separate from the spot price. And it's the futures prices that receive the most weight when analysts are looking at the oil industry. Well, the same should be true of gold, but it's not it is not customary to worry about the futures market in gold.
So what someone is willing to pay for oil 2 years from now? So what is someone willing to pay for gold 2 years from now? That would be a good measure of whether we have inflation or not. And someone might be very willing to pay for gold in 2 years because they think inflation's higher. Is that the thought?
Yeah, let me give a practical example. Suppose the Iranians or somebody from the Yemen actually succeeded in seriously bombing one of the Saudi Arabian oil fields. There would be an immediate scarcity of oil. So the spot price of oil would jump. But the futures price of oil, say 5 years out, and we have a fairly active futures market for oil at various horizons, would not be so affected because the markets know that whatever damage is done to the Saudi oil fields can be repaired. And over a period of 2 or 3 years, the repair will take place and the price of oil will go back to what it was before. So if you were trying to make a transaction in oil that would be consummated 5 years from now, you wouldn't be particularly worried about the bombing of the airfield, about the bombing of the oil field. So the price of oil in the futures market is a much more stable, long-term indicator of the value of oil as a resource. Same thing with gold. Gold, in its natural form, is a hedge against inflation, and therefore the price of gold is a measure of how much inflation we should be worried about. But if we look 5 years into the future, the distortions that may exist in the present will not be serious, and we can get a better measure of the inflation potential from that 5-year data than we can from the current price.
And when we get back from our next break, we're going to talk about, well, what does that futures price in gold indicate right now about inflation and more. This is Josh Jalinski, the financial quarterback, with David Ranson, taking your questions on youtube.com. And again, if you miss any of this exciting broadcast, you can go over to the iHeartRadio app or Spotify right now. And folks, call us at 888-988-JOSH, and we will make David's latest write-up free when you schedule and keep your own 45-minute ultimate financial game plan. This is Josh Jalinski, the financial quarterback. Don't touch that dial. And we're back. This is Josh Jalinski, the financial quarterback, with David Ranson of HCWE, H.C. Wainwright Economics. So what does the futures market in gold tell us? Gold and silver, as indicated by kind of the ETFs, GLD and SLV, are kind of down lately. What does the futures market tell us?
The futures market has been telling us since the beginning of the year that the dollar is losing value, and not just the US dollar, but many other currencies around the world. And this was actually consistently happening from the very beginning of the year until about midsummer. And we had a cumulative decline in the value of the dollar, measured this way, using the futures market for gold, of about nearly 20%. That implies 20% inflation, roughly. And indeed, the best indicator, immediate, timely indicator of inflation suggests that we have, in fact, had, since that time, about 20% inflation. Most of our official indexes of inflation are constructed in such a way that they give a much lower number.
Yeah, they're
unless
manipulated
you
by the
wait
government.
another year or two.
And you know how I think you're right about the 20% number? Just look at a bag of potato chips, right? You get 20% less than you did about a year and a half. You know, I would always say, okay, look at potato chips because the bag would be half. Now the bag is 3/4 of the, you get 3/4 air and 1/4 potato chip. When you buy.
Yeah, the standard example of this is the Hershey bar.
Yeah.
I think it's a true story, although I've never researched it. But back in the 1940s, there was a Hershey bar that had, I don't know how many ounces of chocolate in it. And at some point, the company decided to reduce the amount of chocolate, but keep the price the same. Well, of course, the price isn't really the same because we should be measuring the price as how many ounces of chocolate you get for $1. But that isn't the way it was done at that time. So you can distort a price index if you don't take account of whether the piece of material or goods or services that are being valued are remaining the same over time. Well, economists have gotten more sophisticated about this over time, but there's a heavy tendency for the value of what you buy and sell to be changing all the time, especially if we're talking about services rather than goods. In the case of a Hershey bar or a bag of chips, these are things that are almost commodities, and you really can't hide the price of a commodity unless you conduct something like this Hershey bar experiment, which nobody would accept today. But in the service industries, take getting a haircut, for example, I always pay the same amount for a haircut, but I don't always get the same haircut when I pay for it. Sometimes I have to queue up. Sometimes it's plenty of time and I get a much better haircut. Sometimes the hairdresser pays attention to what I ask for and sometimes not. But the price of my haircut is always the same, and that's what goes into the government's index. And so the government's index is not taking account at all of changes in the value of haircuts generally.
Do they take into account the cost of Hershey bars?
Yes, I don't know the story. As I say, I haven't researched it, but I think they do now measure candy as the number of dollars per ounce of chocolate or whatever the candy item is.
But what they're not seeing is now, right? And this is, I also think, where you have inflation. I like chocolate. I don't buy Hershey's anymore. You know, you buy Lily's chocolate because it has no sugar and it has stevia in it. You know how much a Lily's chocolate bar costs? $3.50. Or if you buy, if you go down the chocolate aisle at ShopRite or wherever, you know, Stop and Shop or Gennardi's or wherever you buy your groceries. I don't know where you buy them in Oregon. What's the place by you? The groceries.
Well, we belong to Costco, so we buy a lot of this stuff in larger amounts.
Yeah, Costco. So you buy colon cleansing quantities of chocolate, and now it's much greater volume. So as we talk more about this whole subject, so are you a believer in transitory inflation or permanent? What do you think?
I think the simple answer is it is sustained. I wouldn't say permanent, but it's not transitory. And the main reason why it's not transitory is that a lot of this inflation all took place months ago, and it's already happened. And we now have to wait until our price indexes very slowly reflect it properly. That's why I mentioned the Producer Goods Index, because it is an index that doesn't really wait much. I have estimated how long it takes for it to reflect the amount of depreciation in the dollar, and it's only a matter of 4 or 5 months. But the CPI that everybody works with, that takes 1 year, 2 year, 3 years to fully reflect the inflation that has taken place. It may take even longer than that.
So I bought a new van that was, you know, seats like 12 or 15 passengers for my 7 children. That van was going for $45,000 fully loaded, including taxes. Now that van is about $69,000 if you were to buy that van today. It's crazy. Proves your point that it's about 20%, although that's greater than...
Percentage too, yeah.
That's much greater than probably due to the metals and the chips and all that stuff. That might be a little transitory. But...
Well, I mentioned Hershey bars, but actually being English, I don't eat American chocolate. I still eat British chocolate. And you will occasionally see the brand Cadbury's in the grocery store. And I buy it online where I can get much better prices. But in the store, I watch the Cadbury's prices just as a way of measuring what's going on. And they too are up 20-25% from what they were at the beginning of this year.
So as we are figuring this whole thing out, let's look to Cadbury's. Is Cadbury's better than Hershey's?
For my taste, yes, but you might not agree with me if you tasted them. It's all a matter of taste.
Is Cadbury's creamier? More milk fat?
It is milk chocolate, yeah. Hershey's do sell milk chocolate, but they also sell the regular chocolate, which is doesn't have any cream in it. So you can have it both ways with Hershey.
Do you like the cream or no cream? The cream.
I definitely like the cream. I take cream in everything.
The European chocolate is creamier. Although I like dark chocolate for the health profile.
Yeah, Belgian chocolate is really superb.
Yeah, you can't beat some.
And they put a lot of effort and skill into producing it, so it is actually quite a bit more expensive than our chocolate.
Yeah. So, folks, give us a call, 888-988-JOSH, if you want David Ranson's latest work for HCWE. We'll provide that at no charge when you schedule and keep your no-obligation review at 888-988-JOSH, 888-988-5674. And if you're worried about your portfolio and the effects of inflation on it, call us now at 888-988-JOSH. Up next, we're going to be talking about portfolio tips with Dr. David Ranson. Also, a little bit more into infrastructure spending and how it really doesn't do anything for the economy. When we return, this is Josh Jalinski, the financial quarterback. Don't touch that dial. And we're back with H.C. Wainwright's Dr. David Ranson. So, infrastructure, in one of your latest HCWE forecasts, Economy Watches, talk about the trade-off between federal spending and private spending. And data from 1929 shows that actually things decline the following year. Why do you think that is? Just public investment crowds out private? And what other insights from that article do you have for our listeners and watchers at home?
Yes, well, you used the phrase, as you used it, crowding out. It's a very old idea. If the government does something, it crowds the private sector out of that business, and the private sector ceases to do it. And the idea of the government is that it's adding to GDP, but the crowding out part of the story means it's also subtracting from GDP, and you may end up with the same GDP you would otherwise have had if the private sector had done the job in the first place. In practice, you can measure these things. Now, my job, what I do for a living, is to measure this as precisely as possible. Some things can't be measured precisely. This is one that can be measured if you use lots and lots of data. And as you say, we have data going all the way back to 1929. And there's one pretty consistent database that I use that goes back to 1945. What happened during the war is slightly different. So I don't try to generalize too much. I'm looking at peacetime infrastructure and other kinds of federal spending from 1945, that is, to the present. It gives us 70 years of data, which is a lot of data, and enough to be able to measure whether we get a larger GDP from having the government increase its spending or a smaller GDP. And to a first approximation, there's no difference. But if you measure it more carefully and precisely, you find you get less GDP, slightly less. than you would have if the private sector had been doing the job in the first place.
And so, what asset classes do you like now, given your background in economics? The other thing I wanted to say, a couple days ago, an article by Market Watch, gold futures fall to their lowest settlement in about 6 months. Is that a bad sign for gold? Or positive?
No, that's a good sign. And I was going to tell a little bit more of the story about the futures gold price. In the first few months of this year, the futures gold price was rising quite a lot. In fact, about 20%, just about the right amount to explain how much inflation we got. That was until midsummer. And since midsummer, it's paused, stabilized, and even come back a bit. I can't explain why. I can't explain why it rose in the first place. All of these things have to do with public confidence in the monetary system. I can't see any other explanation.
Well, the decline.
Why public confidence?
May I add something due to the decline? It seems we had a washout in the Bitcoin market. Bitcoin is a contra gold, sort of a digital gold. People were losing faith in Bitcoin over the summer. It seems to have regained its luster in the eyes of some. It's back to like the 40,000 mark. So maybe that, obviously we don't have a lot of data on gold versus Bitcoin because Bitcoin's a relatively new asset class, last, 11, 12 years. But it seems that as Bitcoin was rising, maybe it was crowding out some of the investment that would have gone to gold. I don't know. Maybe that's my take. What do you think about that?
Well, I think gold and Bitcoin move in parallel more than they move against each other. But to be honest, I haven't done the work that I need to do to say anything confidently about Bitcoin. As you say, the history is only 11 or 12 years. That's nowhere near the kind of histories that I need to do most of the work that I do.
No, but here's my thought.
It's only a matter of time, though.
If you were into Bitcoin, you were into gold 12 years ago. You were into a hedge against Fed money printing, all that stuff, government spending run amok. Like it attracts the same type of person. So
I think it does.
So I know a lot of Bitcoiners who say, well, I'd rather have digital gold because I could take my digital gold on my stick and flee the country if I need to, or they could, whatever. They could have more anonymity. They don't have to like ship it in trucks and pay people to store it. And so there are a lot of former gold bugs who are now Bitcoiners. So that's what I mean. Like the same dollar is now being split.
Yeah, I understand.
So as Bitcoin kind of fell, gold was rising a little bit. And then as Bitcoin started to regain its hold again, gold came down. Maybe that would explain it. But long term, you're bullish on gold.
Yes, I think the present monetary system, based on what they call fiat currency, is inherently unstable. And it's only a matter of time before people lose even more confidence in it. And things like gold and Bitcoin and many other alternative monies will slowly take over instead. But these Bitcoin and other monies like Bitcoin are technically very difficult to understand. And that's holding them back, I think, initially. Everybody understands gold. But gold is not easy. Of course, it's a very valuable thing. You can't store it in your house. You get burglars the next night. So nothing is perfect.
No, exactly. And what other asset classes do you like for this time period that we're in? We talked last time about your star portfolio. Any opportunities you see upon the investing horizon?
Yes, I think one of the major things that's happened over the past year is a big improvement, a resurgence of business confidence and a fall in business or economic anxiety. And we can measure this in the bond market. One of the best measures of this would be what they call credit spreads, which is when you compare one junk bond or one low-grade bond with another one that is slightly different in quality, and the difference in the interest rates tells you how much anxiety is driving them apart. And all of this has changed quite a lot since the depth of the pandemic scare. And so we have much better business tolerance for risk today than we had a year ago. And that improvement in business tolerance means that a lot of capital will stop sitting in safe havens and go into risky investments. And if we're in an inflationary situation at the same time, then what the asset that benefits in both respects would be what's called a real asset, such as commodities are real assets, and real estate is a real asset. And there are many other assets that behave, they may not be real in the same sense, but they behave as if they were real. That includes things like variable rate bonds and also the deepest discounted junk bonds. And quite a lot of other more exotic instruments. These are the asset class that I think benefits most from the current scenario.
And do you like Treasuries right now or not really?
No, the Treasury is on the other side of a seesaw. As capital is moving away from safe havens towards risky assets, it's pulling itself out of Treasuries, which are one of the major safe havens that we rely on. So this means that Treasury rates will have to rise, Treasury prices will have to fall.
So do you, so would that would then be good for stocks as well? So you like equities?
I think I'm pretty neutral about equities. I think equities over a long period of time will reflect the growth of the economy. I'm not terribly optimistic about the growth of the economy. We've had some very high growth rates this year, but they're not continuing. They've already slowed down dramatically. We're running at about 1.5% growth currently in the latest data, and I'm very interested in what the latest figures tend to show. And that implies a pretty flat stock market if you don't look at any other factors. One of the factors you might add to that would be inflation, which would hurt the stock market even more.
Wonderful. So we'll be back with Dr. David Ranson. So folks, give us a call, 888-988-JOSH, and you get your 45-minute ultimate financial review. We go over protection, savings, and growth strategies in these uncertain times. So if you want a second opinion on your portfolio, now is the time to call us. And we'll throw in one of Dr. Ranson's works at no charge, 888-988-JOSH. He wrote a great article for our listeners that I think would be powerful on the STAR portfolio, which was a portfolio that he coined that weathered March of 2020 fairly well. And I want him to talk about that when we return. And that'll be our free gift to you at 888-988-JOSH, 888-988-JOSH. We'll be back after these messages. And we're back with Dr. David Ranson. So talk about the STAR portfolio, because there are a lot of listeners, I'm sure, who go, I'm worried about the market, but I don't want to have all my money in cash. And I want a properly diversified portfolio. And I read your article on the STAR portfolio. I think it was your greatest article that I read so far. I thought it was just simple and powerful. And we do sort of an adapted, we kind of do our own version of it. And I found it interesting that there was some similarities where you have some gold, you have some commodities, you have some treasuries, you have some stocks. How did you come up with it, number one? And two, how did you get the ratios? And how far have you examined the portfolio?
Yes. Well, to start with the last question first, my data go back to 1969. So I can examine what different kinds of portfolios would have done over that whole time period. What is it, 45 years or something like that? And no, it's much more. Hold on. It's how many years
52.
Is that? 70.
52.
Yeah, nearly 50 years.
52.
Yeah. Yeah, more than 50 years. Good, yeah. When we started testing this, there were only 45 years, but time has gone by. So I guess we have now.
Do you literally have books and books, or you put in spreadsheets?
Well, it's all on the computer. Yeah, it's essentially a spreadsheet type data that's on the computer, and we have the. I use the assets that are most obvious for this purpose. There's no major disagreement about what the assets in such a portfolio ought to be. They clearly would have a healthy amount of stocks and an even healthier amount of government bonds, because government bonds have the nice property that although they can decline, they generally don't decline very much, even when the winds of change are against them. Stocks are much more volatile than bonds. So on the whole, you would have more bonds and less stocks in a portfolio in order to have the two assets balance. But those are only two assets. The idea of this star fund, and there are other permanent portfolios as well. I said before that I didn't make any of this up. These are all ideas that other people have had decades ago that I have adopted and researched. And so this is just my version. Commodities would be a suitable component, possibly real estate, and the other component would be gold itself. And so most people who offer these kinds of portfolios, and there are quite a few of them, and Ray Dalio is most famous, I think the choice of the assets is straightforward. Everybody would choose the same assets to include, but the weights attached to the assets tends to be done very subjectively. What I did, the only thing that's different about me is that I tried to compute statistically what would give you the optimum portfolio over this whole, what is it, we mentioned it's 52-year period, I guess. You can measure what the optimum mix would be over that period. And it tells you that is what you want to optimize. You don't want the highest possible return, because the higher return you go for involves higher variation and volatility. What you want is the ratio between the return and the volatility to be highest.
So you want a smoother ride.
That.
So this might be an ideal portfolio for someone nearing retirement, and retirement, kind of a smoother ride, you would say.
Yes, it gives you, what you're trying to do is get the smoothest possible ride and still have a good return. You aren't going to make as much of a return in the long run as you get from stocks, but you're still going to get a very good return. And we've done a lot of tests of that kind, including the test that's in the paper you just read, which goes back it's in real life. It's a real life test, not just a theoretical test. And it goes back about 5 years.
No, fantastic. And talk, as we conclude the interview, and this was fantastic, talk about drawdown risk and how that portfolio fared, because I think a lot of people listening as we conclude the segment don't understand drawdown risk and why it makes a big difference in retirement.
Well, drawdown risk is important, but I'm not sure in the long run how much of a difference it makes, because if you buy and hold, even when the market falls, but you keep holding, you don't sell, you're going to get your assets back, and surprisingly quickly in most cases. If we had a really bad recession, you might not. But bad recessions haven't occurred for a while. Well, 2008 was a fairly bad one, but it wasn't as bad as some earlier ones. And the pandemic recession was hardly a recession at all, in the sense that we snapped back, the whole economy snapped back, and the stock market snapped back even more quickly. So, but still, drawdown risk is extremely disturbing to people who hold assets, particularly people of my age and so forth, who depend on their pension fund. And so you want to minimize the drawdown risk. That's what this kind of portfolio, it's called the permanent portfolio, and our version is called the star portfolio, just a name. And the right mix of assets will minimize the drawdown. So if you were in stocks during 2020, last year, you would have had a drawdown of something like 15%. That's the worst it got to. And that's it's pretty scary for anyone going through it. But if you had this permanent portfolio with the right mixes of stocks, bonds, commodities, and gold, the drawdown, I believe I calculated in the paper, I'm trying to remember the exact number, but it's something in the area of 3%.
Yeah, I think it was two. I thought it was two, but
Two.
two to
Two.
three.
Yeah, it's
Well,
probably
this was
2%.
so much fun, Dr. Ranson. Hope to have you on again in the future. Anything you want to plug or just your website, hcwe.com?
Oh, I encourage people to look at the website. I apologize that my work is technical. It's designed for fairly technical people in the financial industry,
Well,
but I
we're
also
trying to
write commentaries
popularize
which are
you.
not so technical.
Well, we're trying to popularize you for the masses. So you're a
Yes.
real gem. So, and we
Well,
enjoy
thank you.
having you on. So, folks, Dr. David Ranson, we do have a lot of people in the financial industry who listen. So, hcwe.com, and hope to have you on again in the future. Thanks for joining us.
Thank you.
Bye, Dr. Ranson.
Yes, thank you, Josh. That was great.
It was fun.
Okay, Josh and Ernesto, I just need that top of the hour start off.
Yeah,
one more
we'll do
time.
that at the end of the next interview because he's in Europe, the next guest.
Oh, okay.
And we're going
I
to.
remember. I know Larry Kotlikoff. Yes. How are you, Larry? Can you hear me?
Good, Robert. How are you doing?
Good.
Yeah,
Yeah, you were a lot younger, and I was a lot younger when I last met you. It goes back to the 1970s, actually.
I think so, yeah. How you doing?
Oh, good. Yes, I've escaped the pandemic, and so have you, obviously. Yeah, we're doing good.
Good.
next time we'll have a
Where do we
debate
meet
between
at?
Dr. Ranson and Dr. Kotlikoff. That'd be fun.
Yeah.
Well, for sure. Absolutely.
And
So I forget where we met last, Robert. Do you recall?
Well, you were at the Federal Reserve Bank of Boston, and I was visiting, and I think I met you there, and I think we went out to lunch once.
Okay, yeah. Okay, right.
Long
it's
time ago.
Dr. David Ranson. I don't know if you said Robert, but well, thank you, Dr. Ranson. It was a lot of fun.
Yeah. Robert is my first name, but I don't go by it.
Oh,
I
it's
go by
Robert.
David.
Okay, there you go.
Mm-hmm.
Well, great to see you, Dr. Ranson.
Good to
Yes,
see you, Robert.
thank you very much for having me.
It was fun.
Bye-bye.
Okay.
Good to see you again. Okay, take care.
You
Okay,
too.
now we got Dr. Kotlikoff from Europe. He sounds like
Hey, Josh,
he's
how are you doing?
Hey, buddy, how are you?
Good.
Thanks for your
Good.
patience. I was running behind. Are we ready to go live?
We should stop with the radio and then restart.
Okay, stop with the radio and the YouTube, and then we'll restart now, like in 60 seconds.
So just give me 60 seconds, everybody.
Hang on, I'm just going to turn off this light back here.
I have to call the radio station.
You know what you could do when I'm Larry, when I'm on like in a hotel room, there's like a lamp.
Yep.
Put the lamp on in front of your face. It's a little weird because you're blinded, but it makes you look better.
Okay, let me just turn this off in the back. Maybe it's a little better. Let's see. How's that?
Yeah, it's better.
We're starting the hour.
Or sometimes, like when you get those lights, you put them where
You're fine.
you basically want it to where your face is looking into the light if it's tolerable.
Yeah, unfortunately, the only light that, I can bring it a little bit closer.
Yeah. It seems awkward, but it looks better on the camera.
Let's see if that's...
Yeah, I mean, you look good. I like your TikTok.
Yeah, I got to get going doing a few more of those.
Yeah.
I got this new book coming out that's so I'm trying to get that rolling. So you're starting a podcast, huh?
Yeah, I saw
cool.
your. Well, we can talk about this on the show. That'd be fun.
Okay.
I haven't gotten approval yet from my compliance people on TikTok because they don't have retention, and if we're audited,
Okay.
But
Right.
are we ready?
We're ready to go.
Oh, are we live on YouTube?
We're live on YouTube. I'll update them.
And put his latest article. Okay, 3, 2, 1. Hi, everybody. This is Josh Jalinski, the financial quarterback, with my father's all-time one of my favorite all-time guests, Professor Kotlikoff, back by popular demand. Now he is a TikTok celebrity, along with 18-year-old girls and people who dance. Now we have people who educate the next generation on finance. So Dr. Larry Kotlikoff of Boston University fame, who just was featured in some big article telling retirees how to spend their money and just leave it a lot in cash, which I got to get that article. That was a fun article I want to read. Yeah. What was that article? Do you know what I'm talking about? You got some national press on something.
I think Barron's did a profile, and then there was some a lot of comments. Some people were negative because I talked about pulling out of the stock market before it crashed last March, and so then there was I responded to the comments. So I was like on Barron's homepage twice for like 2 days.
Well, and, you know what? I salute you, Larry. You know why? So many people are retired, and they did sell off in COVID, and a lot of professional money managers sold off, and they didn't tell anybody. A lot of people in the know sold off because it was a scary time to be an investor. And I think what it underscores is when you're nearing retirement, you should have a certain amount of money not tethered to the market, because we could have COVID. We could have some other bio weapon years from now. We could have COVID, Mu or Lambda or, COVID Z. Talk about that, because I really appreciated your honesty, and I sort of agreed with you slamming the average retirement planner. I'm sure, the people who were trolling you with negative comments were probably financial advisors who were unsuccessful, who had nothing better to do than troll you on the article. But I liked it. You were honest. What do you think about that?
First of all, they didn't have an opportunity to hear what I really was trying to say in full, because I was just, in this profile, there were some questions. I gave a longer answer, and the reporter didn't have the space to fully convey. So I don't know whether we really had. So here's what I was trying to convey that unfortunately didn't get into the profile, which is that economics tells us, finance tells us that we shouldn't try and time the market for return, that we can't guess, or we can't kind of predict where the market's going to go. The market's basically a random walk, and where it's going to go depends on new information that comes in, because existing information has already been processed by the market. If it's efficient, we have a very highly efficient financial system. So only things that people don't know, which is new news, are going to come in and change the market return, and that's not predictable. So that's why we economists think that you cannot time the market for return. On the other hand, you should time the market for risk. Finance also tells us that. So when things get riskier, when the economic environment gets riskier, and it certainly was riskier at the beginning of COVID, it's still riskier, I think, given that we're not out from under COVID. But when you start seeing the economy shut down, you've never seen that happen. You don't really know how many people are going to be able to work remotely. Well, the market's much riskier. The VIX, the index of risk, is going up. So personally, I said, well, I'm going to do what economics says to do, which is to reduce my holdings. And sure enough, the market dropped 34%. Other people pulled out. And then something that I didn't really predict happened, which is that the Fed came in and started buying up corporate bonds like crazy to support, in effect, the stock market.
Had that ever been done before, right? That was never been done. That had never been done before, correct?
Well, I think you could argue that they did this in 2008 in the Great Recession, a little bit, late in the day.
But that was the Fed buying treasuries. They weren't actually buying corporate bond ETFs like LQD and iShares and Vanguard. I mean, I thought that was uncharted territory. Right?
I think there's probably been, so, I think you know more, Josh, about the details of what they've been buying, but I do know that in the Great Recession, they were buying some pretty, they were buying, they were basically jumping in as the bank of the country,
Yeah.
and making loans to all kinds of entities, and which I think, we had a financial panic, and the market still dropped 53% between 2008 and the kind of the middle of 2009. It was down 53%. So even with the Fed coming in, there's no guarantee the market is going to go back up or right away. So it's a riskier situation. I pulled out. So that was the smart thing to do. And I think that you're right. As people get older, they can't. There's nothing. Most people think that the stock market is safe in the long run, and there's this entire bucketing strategy that the conventional financial planners tell their clients that, look, we're going to put this much money into stocks, and we're going to take it out 20, 30 years from now, because over the long term run, we can trust that it will be there with a decent return. Well, economics doesn't tell us this. Finance tells us the opposite. When you have a random walk, things get riskier with time, not safer. And if you look at the actual cost of buying insurance against the stock market going down below a certain value, kind of buying a put on the market, it gets more expensive the further out you go. So the stock market is riskier, not safer in the long run. So we can't count on it. We just have to know that it's like going to the casino, but it's a casino that's not geared against you, where the dice are loaded against you. It's a casino with a great return on average, but a lot of volatility. And when you put more into the market, your upside on average is going to be much higher, and your downside and the chance of your making losses will go down, but the magnitude of those losses will get bigger. That's the important thing to understand, that the magnitude, you'll have fewer cases of losses, but when they're bad, they're much worse. So we don't want to be living on cat food, obviously, in old age. So we, putting in a reasonable amount in the stock market, but timing it for risk, these are sensible things to do.
Yeah, I don't really understand the brouhaha over the article. There apparently were 200 plus comments like the first day on the article, which signals to me that financial advisors were on there who had nothing better to do to negative. But I think you bring up so many good points because of the honesty. And I think it underscores the need for retirees to think about risk, volatility, and what you are, personally, everyone has to build a portfolio. I always say this, that you won't vomit out when the market goes down. And it could mean only 25% in the market, or 30 or 20 or 40. And you never hear that. And that was why it was kind of cool that you were saying that. You also never hear when a finance guru gets it wrong, because they are rarely honest about that, because they want people to believe they are the guru or the shaman on the mountain. And I love that you were honest. So I commend you for the article. I think it was, I didn't even know about this comment thing until you told me about it. And I think most people, I never read the comments because it's always trolling or something. And
they usually, they're usually negative. Comments are usually negative.
So if I'm featured, I never read a negative comment. But just because it's then you're fighting the people. Although, hey, it probably got more publicity, and they probably will want you to write a follow-up on it. But I would agree that most retirement planning is wrong, because they don't follow the teachings of economics. They follow math. And money is not math, and math isn't money. I want to get your take on that topic. But first, we got to take our first break of the hour. with Larry Kotlikoff, guy who grew up in Jersey, Camden, New Jersey, and made a name for himself as one of the top professors of economics in the world. So, folks, if you have a question for him, go to youtube.com, search for Josh Jalinski, the financial quarterback, and write it in the chat box. We'll be back in a moment. And we're back. Give us a call, 888-988-JOSH. If you want the 45-minute ultimate financial game plan for retirement, or one of Professor Kotlikoff's, we'll also throw in his Maxify Planner if you want that, or his MaximizeMySocialSecurity.com review. So, Larry, what do you think about that? I was taught by a mentor in the industry. This is when I was 23. Money is not math, and math isn't money. Comment on that. I love that quote.
Well, yeah, I mean, that's a good way of putting it. I mean, we're focused ultimately on our consumption, and we're worried about we really are interested in having a smooth ride with respect to our living standards. So we're not just interested in finding some way to accumulate the most amount of money so that we can die with the biggest, unspent bundle of cash, so deprive ourselves our entire life. So we have to, focus on the bottom line, which is not money per se, but it's consumption. And we want to make sure our living standard, our consumption is steady and is able to withstand shocks. That our living standard, if the market drops, we want to make sure we're diversified so we don't have everything in the market and lose our shirt and then maybe panic, or not panic and just say, this is too much for me. I've got to get out, get to some safety, and then I've got a lower living standard the rest of my life, especially for somebody who's retired, who's not able to recoup by working longer. So economics definitely, we use it's a highly mathematical subject. Every paper I write has mathematical equations out the wazoo, but they're about people's concerns about risk and sustaining their living standard, and how they can optimally, deal with the risk, and also make smart moves that don't involve risk whatsoever in terms of raising their living standard. Like, you and I have talked a lot about Social Security over the years. There's downsizing your home. There's Roth conversions. There's issues of moving to states without taxes. There's working longer. There's all these, in terms of retirement, there's all these safe ways, or relatively safe ways of raising your living standard that don't involve investment issues, and people aren't really taking advantage of those. So that's one of the things I've been trying to convey. I wrote I don't know if we talked about this yet, certainly not online, but I have a book coming out called Money Magic in January. It's coming out January 4th. And if people can see, I'll just show you the cover. It's a really cool cover.
I'm excited about it.
It's got rabbits coming out of a hat. Now the rabbits are origami rabbits, and the paper that they're made out of is dollar bills.
We'll
So
show
really
the title.
cool.
Show it again though, because you faded out because you're in a lab.
So money. Yeah, can you see that?
Oh, there we go.
Money
An
Magic?
economist's secret. So I want to know what these. So one of these are, and this is critical, folks. Money is not math, and math isn't money. Yes, I mean there are formulas and stuff, but what I mean is the general. I loved the Barron's article because I would argue the general formula applied by most financial planning today. And now I don't want to tick off financial planners watching, listening on the iHeartRadio app. If you miss a part of the episode, go back to iHeartRadio app, go to our Spotify app. Most people use this formula. I'm not the professor, so I'm sure you have a better formula. Money equals rate of return, the risk you're willing to take, times the amount of money you're going to put, wealth you're putting in, times time. Basically, 99% of financial planning uses that basic formula, which to me is inherently flawed. There's no inflation. There's no taxation. There's no risk. Then there's like the risk you're willing to take. But then what happens when your actual, I don't know if you would call it the risk quotient or risk acceptability. Like when you see your actual, like you said, if you have a larger account, let's say you're worth $2 million and you had Coke stock, Disney stock in March of 2020, and you see it go down and your 2 million is 1.2. How would you feel? Like you came from nothing and you lost 800 grand in a month. That you could probably make it a formula, but that's what I mean when I say money is not math and math isn't money. That money erodes over time. There are wealth eroding factors. There's all these things that people are just oblivious of from their average. I really like the article. I thought it was a good article, Larry.
Cool.
We had Barry Dyke, I don't know if you heard of Barry Dyke. He wrote the book Pirates of Manhattan.
I think I've heard of him, yeah.
He loved the article. This guy sold 30,000 copies of a self-published book, and he kind of went in and exposed like what banks were doing with their money in 06 and 07, kind of leading up to the crash. It was very interesting. And we used this article because it came out right before my interview with him. I was like, this is a really good article. And he agreed, and I agreed. I think the traditional, what I would call Wall Street industrial complex of funds and stockbrokers and funds, they want you to have all your money in the market. But I think a lot of people would benefit from an annuity or from, things that are more conservative, not for all your money. Of course, stocks are better for the long haul, but you have to understand like what you're willing to take on with risk. And also what you talk about consumption with your Maxify planner. Another word for consumption is enjoyment. You don't want to be not enjoying the last 10 to 20 years of your life on earth, and then you die, and then some ungrateful kid gets all the money and pisses it away, right? So let's talk about money magic. What are some money magic moves that our listeners can make now? I know we've talked about this before, but I always think they're good tips, since you're usually the Social Security guru.
The book's like 300 pages, and it's really geared for everybody. There's discussion of career choice for younger people, and whether one chapter is called "Don't Borrow for College." There's a chapter about marrying for money. There's a chapter about how to get divorced like an economist, and then invest like an economist. And what does that mean? How do we think about investing as opposed to conventional planners? So and then Social Security and dealing with retirement accounts. But in terms of some magical trick. I mean, right now, if I was thinking about investing, I would say the best investment is to pay off if you have any student loans with high, those interest rates are high, even though they're have been issued by the federal government, they're typically around 5.
But what if Liz Warren becomes the president and forgives all college debt?
Yeah, I don't see that happening. It could happen, but I don't. I just think that's so unlikely.
Who's your presidential prediction for 2024?
Oh, Trump against Biden. I think Biden will win. I think Biden will.
It's going to be Biden, Trump again. I think it's going to be DeSantis versus someone else. I think Biden steps down and we have somebody else, but that'll be interesting. We'll be right. So you're calling for a Biden-Trump rematch?
Well, I think that's probably the most likely, but not very high probability. I mean, it's probably 60% probability that's what we'll have. And I think Biden actually is doing a good job on balance. I don't think he's made any huge mistakes. We could discuss what happened in Afghanistan and whether that could have been done better. I'm sure it could have been, but he bit the bullet and got us out of there, which we should have gotten out of there 15 run in.
I don't want to go there. The withholding of Regeneron. I had COVID, right? Regeneron saved my life, and they're withholding. But anyway, I don't want to get political here. But the withholding of Regeneron, I think, is one of the greatest misreported crises of the last year. But
they're withholding it now.
Well, they said they were going to ration it out of the red states because there was less vaccinated, or Then they got some bad press for it, so they retooled it and said basically they're distributing it. But anyway, I think we'll probably. Oh, go ahead. Sorry.
Well, anyway, so in terms of money magic tricks, there's clearly being patient with Social Security. For most people, we should have about 75-80% of workers waiting till 70 to take Social Security. Only about 6% at most are doing that. There's a huge gain to be had there. Most people are taking their Social Security before they take their retirement money. It should be exactly reversed. People need to know about the 13 different Social Security benefits that are out there, because a lot of people don't know to ask for benefits that are due to them, owed to them, and then they don't get them. We have to think about, Roth conversions from your, if you want to take your retirement account, your IRA, and traditional one that's taxable, pay taxes on the money, put the money into a Roth because you're worried about future tax increases. That might be a smart move, but it might also kick up your Social Security benefit taxation. It may also kick up your Medicare Part B premiums 2 years later if you're going to be, because those premiums are connected to your modified adjusted gross income 2 years before. As crazy as that is.
And that's in your Maxify planner, correct?
Yeah, all this stuff is in the software. And what I did was I've spent years developing the software, and all the lessons I've learned from running the software I put into this book, because I know, a lot of people like to run the software, but a lot of people just like to know what to do, and don't have necessarily the patience or interest in running software. So I try to, provide enough cases that people would see exactly what position they're in, and then know what to do on any particular issue. There's a whole chapter here about college and whether it pays to borrow money to go to college, and how to work around, how to actually get to college without borrowing money.
Well, we'll talk about that when we return with world-renowned economist Larry Kotlikoff. You can go to maxifyplanner.com if you want to sign up on your own. It's a very powerful way to plan, not just for saving money, but also income. Income is sort of the outcome, and it doesn't use outdated rules of thumb. You can go to maxifyplanner.com, or you can call us at 888-988-JOSH, and we'll throw in a Maxify Planner report customized to you and your family for free when you schedule and keep your no-obligation 45-minute ultimate game plan for retirement, 888-988-JOSH. And go over to Amazon.com, buy any of Larry's books, or you get one book free by Professor Kotlikoff, whether it's on Social Security or whatever book you want. Call us, 888-988-JOSH. Now, 888-988-5674. We'll be back after these messages. And we're back. This is Josh Jalinski, the financial quarterback. We're talking to Professor Kotlikoff, who created the MaxifyPlanner.com. That'll focus on giving you more peace of mind, more money, smarter decisions. And it uses the work of economics, not just financial planning. A lot of these financial planning tools, they just do all these things. They tell you the pie. And what I love about your stuff is it's beyond that. It focuses more on real life. And a lot of times people say, well, I did a financial plan and it didn't work. And that's because you didn't focus on all of the negative variables. So talk about that, Professor Kotlikoff. First, the cliffhanger. What was the cliffhanger? I forgot it. It was college planning, and then we'll go to software construction and why most financial planning software is a little misguided. What about college, planning for college? What are your tips there? How do you fund college? Don't
first
go.
of all, 40% of the kids who go to college, who start out going to college, drop out. Okay, a lot of people are borrowing a ton of money to fail out of college, so it's highly risky just to begin with. Just from that single statistic should give people pause about borrowing money to do something where before you even start out, you've got a 40% chance, if you're the typical person, of borrowing money for nothing except to pay the money back. And you can't get out from under it. You can't discharge your liability through bankruptcy when it comes to a student loan. They'll take it out of your payroll. They'll take it out of your check, your wages. They'll take it out of your Social Security benefit if you haven't paid your student loans into your 60s when you start taking Social Security. So what I say is don't borrow. If you're in a low-income household, your family's low income, the top schools are heavily discounting tuition and providing grants. So the price is actually cheapest for the people that are poor. So when it comes to college, the poor have a fantastic advantage over the rich, over the middle class and the rich. The rich kids, their parents can pay whatever, so it's not an issue for them. But the middle class kids are really the ones who have to be careful. And what I talk about is that paying a lot of money to go to a fancy name college is just not going to pay off in the marketplace. The research that has been done by economists.
Not even Boston University?
Well, of course, if you came to Boston University, it would pay off, but no, it doesn't pay off. And Boston University can be very expensive. It could be $75,000 for 4 years, and that's a huge amount of money for if you're upper middle class and you get no particular grants and you're borrowing money and then your parents, you borrow up to your limit, and then your parents are allowed to borrow up the difference.
Boston University, they just called me. They have fired you from the director of marketing. No, I'm kidding.
Yeah, no. Boston University will pay off, but everything else will be, don't go, Harvard is the place you want to worry about. But I know people.
I will tell you, I'd rather my kids, I have 7 kids now, Larry. We just had another one.
Oh, Mazel Tov, that's terrific.
I'm going to go broke on college. But I would rather my kids be educated by you than most really wacky leftist economist. I don't know what do you call it? The modern. Are you a modern monetary theory guy?
No, these people aren't really real economists. They're not theorists and they're not modern. They're just charlatans pretending to know. I mean, if you listen to these people, I've debated the supposed leaders of this movement, and what they say has no connection to
reality.
Economic theory. Yeah, reality, and it's very very vague, and they can't write down in mathematical terms what they're trying to say, what they think is going to be true. But what we do know that is true, and this is also important to our future finances personally, is that the country is broke. The country has been running up huge bills. That we have an official debt that's 100% of GDP. It was 30% of GDP back in 2008. So we have, on an official basis, gone crazy with our borrowing. And then Social Security has got about 2.5 years, not 100%, but 250% of GDP unfunded liability, according to their trustees report that came out 2 weeks ago. So just those two things alone shows the country's bankrupt. And then you put everything else together, and the picture actually looks worse.
And it looks worse when you think about the rise of CBDCs. Digital currencies are really taking hegemony away from the dollar. Like, we're losing our foothold. People don't realize for the U.S. to be destroyed as the world reserve currency, they're not going to say buy dollar. They're going to say we're going to get a basket of currencies. We're going to put a little CBDC. We're going to put a little dollar. We're going to make it more of the dollar. So the dollar is going to get 90% at first, and then 80, and then 60, and then all of a sudden it'll be 10%. And people don't realize that will be destruction for the U.S. economy that we've never seen. What say you about that?
So I think the country's bankrupt, and I think the country has been printing money out the wazoo. The Fed has been, the amount of money that they printed is 6 times the stock of what's called base money is 6 times bigger than it was in 2008. So we've had this enormous expansion of money printing. At the same time, the country's borrowing. So a lot of what's going on here is that the Treasury borrows money, and then the Fed prints money to buy up the bonds that the Treasury just sold to the private sector. So it's really just the government printing green dollar bills, in effect, electronically to buy stuff or to give certain people money. And countries that engage in money printing to pay for their bills end up with inflation, and we're starting to see that happen now. A lot of people think the increase is temporary and that it's due to bottlenecks, and surely that's surely a part of it. But there's a basis here in underlying the system, given how much money's been printed in recent decades, for a hyperinflation, really. So I'm somebody who's very concerned about the long-term. When you have the trustees report telling us we've got a $59 trillion unfunded liability, and it's in Table 6F1 of the trustees report, and they hide it in the appendix, and none of the trustees will talk about that. Even in the report, in the summary of the report, they ignore entirely the most important table in the trustees report that says we're 2.5 years broke just from Social Security of GDP. We've got a problem. When we can't pass this infrastructure bill, when that becomes somehow too expensive to and we can't invest in a decent education system. I'm speaking to you now, as you know, from Switzerland. I'm here giving some lectures for the month, and the difference in infrastructure when you drive around Germany or South Korea or Switzerland, I fortunately get to go to lots of countries, and just the degree to which these countries have their acts together, the degree to which they provide decent education to their kids, the degree to which they treat everybody well, so that there's not people that are kind of living on the street starving, the cleanliness of the place. It's just amazing. It's like day and night compared to where we are in the U.S. So we are, as you said, we are at the end of our economic empire, as far as I can tell. And then the other thing is that, if you look at the projections that I've done and others about where China will be at the end of the century versus the U.S., their economy will likely be twice as large as ours, if not even larger as a ratio. So the U.S. is heading towards a second-rate economic status, and we're not going to be able to police the world. We're seeing our pulling back on that, and you're saying the dollar is going to likely not become, it's going to lose its place as the world.
Well, I mean, talk to a kid, talk to your students, right? They don't believe in the dollar anymore. They believe in Bitcoin. They believe in cryptocurrencies, all of these things. It's not like people don't want dollars anymore, right? I mean, I want your take on that.
I think,
actually, when we return, we'll
Sure.
hold that thought. That'll be the cliffhanger. Kotlikoff on crypto and Bitcoin. When we return, This is Josh Jalinski, the financial quarterback. And call us now, 888-988-JOSH, for Professor Kotlikoff's book on Social Security, or the max5planner.com, or get your own customizable Social Security report on maximizemysocialsecurity.com. Free when you schedule and keep your no obligation review at 888-988-JOSH. Pre-order Money Magic. Can that be pre-ordered yet or not? Not yet.
Yeah, if you just go to kotlikoff.net, there's a link.
Go to kotlikoff.net right? And pre-order. It is one of my. I'm looking forward to this book. It's going to be exciting.
You're going to get an autographed copy, Josh.
Good, to give to little Josh, who's going to be class of whatever 2040 at Boston University. As long as you're around, you got to stay alive that long.
And not to worry, but 7 kids, that's a great achievement. Fantastic.
It's wonderful. Kids are just so fun. It's tiring, but they're such a blessing. I mean, they're my oldest 3, because my wife does such a good job with them. They read a book a day, like big books. They're learning Latin at 13. I'll talk more about my kids' education when we return. 888-988-JOSH. We'll be back after these messages. And we're back. This is Josh Jalinski, the financial quarterback, with Professor Kotlikoff. So we had a cliffhanger, and I started talking about my kids, so I forgot the cliffhanger again. What was it?
That's about cryptocurrency.
You know what it is? It's COVID brain. I got COVID. A little bit. I'm a little bit off.
How are you feeling?
A step. Better.
How have you been? How long have you had? When did you have it?
I had it September 2nd. I tested positive, I want to say the 6th, or 5th, got Regeneron the 6th. I could not breathe. I mean, I'm fairly young. I couldn't breathe. So I felt like I was going to die. It was very bad. And I went to the hospital. And then me wait for 7 hours. By the way, there's a solution to COVID. In terms of the hospitals, basically, I knew a nurse at this particular hospital. We were on vacation, and I said, "Is it okay to go to the hospital?" She said, "You really need to go to the hospital. We have Regeneron. You got to get Regeneron. It works. It's like a wonder drug." So I went. They made me wait 7 hours. And everybody, half the people had COVID and half the people were like little old ladies. I mean, you felt bad for them. I was going to say, leave. You're going to get COVID. Get out of here. And I go, can I go to my car so I don't get this 92-year-old woman coming in for a pacemaker adjustment, COVID? They go, no. First come, first serve. If you go to your car, you lose. They should have a very established, if you have COVID, you wait in your car. And then you get a room, and they should have a COVID floor. So I knew that this hospital had so many open beds, because it was like a kind of a podunk hospital in Cape May, New Jersey. No offense if you're from Cape May, but I know you're from Canada. But it was like a little bit backwards. But my wife went there for something that had success. They actually medevaced her to Cooper in Camden, where you're from. So I respected that if I was really a problem, they would medevac me. Where some of those hospitals, anyway, they don't ship you out if you really need to. So I went there, and she's like, yeah, they have a whole wing of people who are open. So what they should have done was had a COVID wing. They didn't.
Yeah,
they
absolutely.
lumped all the COVID people with the regular people, and everybody's coughing, and so they talk about people dying in hospitals. That's why.
Vaccinated?
What's up?
Were you vaccinated?
Was I vaccinated? No, I wasn't. And that was another thing. If you weren't vaccinated, they wanted you to die. So I think that they made me wait 7 hours because I didn't have the vaccine. And, anyway.
How's your wife? How's your wife?
Thank the Lord.
Okay?
My wife was great. All my kids were great. They probably all got COVID, but one showed like very bad flu-like symptoms, the oldest. The one who tested positive, the rest all tested negative, but one of my sons who tested positive, he had 0 symptoms. So it seems to like certain, meaning like the host. I don't think it has any corollary to whether you're fat or all that stuff people say, well, you're old. I think it has to do, like I had asthma as a kid, and it seemed to attack what was weakest. So it felt like an asthma attack on Mach 10. And like they didn't even give me a nebulizer.
Okay.
What's up?
So you're doing pretty well now, though, huh?
Thank God, yeah. I had a great COVID doctor. They gave me, I got prednisone, I got Z-Pak. They gave me ivermectin. They gave me, what's the other thing? Hydroxy. They gave me everything. And because I was pretty bad, and I lost my voice. Still, they say that could be like effects of long COVID, but COVID is no joke. And then we've had a report of a dear friend who lost their daughter, 43, to COVID. So I don't think it's, people got to get it through their heads. It's not age determined. And by the way, we had socially distanced even still. And I got COVID because I contact trace everyone in my office. I'm very anal about this. I got COVID, I think, from my sister who already had the vaccine. So I think it's Delta because the studies I've done. But anyway, they don't even ask you, was it Delta or not? And frankly, they don't even ask you when you go in the hospital if you were truly vaccinated or not. You could lie and tell them no or yes, and they're not like checking a card. And then,
yeah.
But anyway, the Regeneron thing, if you know anybody gets COVID, you got to go before you get pneumonia, or else they won't even give it to you once you get that far. But anyway, sorry on my...
Yeah, that's the monoclonal antibodies, right? Yeah. That's what you mean by Regeneron.
That was like a life changer. But, in one sense, to be honest, I'd rather have gotten the vaccine than it had COVID really bad for 2 weeks. So what's also interesting... Oh, go ahead.
No, you go ahead. Sorry.
What also is interesting, I think everybody needs to get the booster who got it before, because I don't think the old vaccine works against Alpha. I don't really think it works against Delta because of the reports I've been hearing, like 50, 60% of the people who have it are vaccinated now. So it's, but it's,
yeah,
it's a whole, but apparently the results from Israel say that if you got the vaccine, you're 8 times less likely to die than if you did. But then I read some report, it was 4 times from Penn Medicine did a study. But that's the problem. We don't have a central repository of data. So we're just living in the world of like fake news. You don't know whose data to trust. I tend to trust the Israeli data. Where do you go for data?
Well, I actually agree with you. I think they probably have the best information, and certainly they've had 4 different waves of this. This is even though they've got probably one of the highest vaccination rates in the world. So this thing is just a real bitch, this pandemic, and I think everybody knows people have died or gotten pretty sick, and we had a neighbor across the street. They got the vaccine. He got the vaccine. 12 hours later, he passed away. He had his heart stopped working. He had a pacemaker, and I think he had a reaction. We think he had a reaction to the vaccine. I'm not saying to anybody they shouldn't take the vaccine, because I think on balance the evidence is clear people should take the vaccine, but it's a risky world either way.
Because here's the thing. I understand why, if you look at it's interesting. I take all these holistic things, the quercetin, the D, the C, the zinc. None of it were a match for COVID. COVID was just ripping through my body. It was like I was taking 12 quercetin a day. I was taking 10,000 IUs of D, 50,000. At one time, I was taking the zinc. I was taking the C. I mean, COVID was stronger than all of it until I got the Regeneron. And surprisingly, even though it's controversial, my doctor gave me the ivermectin and the hydroxychloroquine and the prednisone. And that, along with the Regeneron, that was the thing that stopped it. But I was getting that lymphocyte, whatever that thing is, it like takes over your lungs. I was feeling that. It was bad. But thank God.
Yeah.
I can swear by my doctor was awesome. Every other doctor you'd call them, they go, COVID, they go, we don't want to see you. And I called this doctor that a friend gave me, Dr. Eck, who's apparently like this world famous COVID doctor in New Jersey. And I didn't know. And they call me like every night, how you doing? And they gave me more stuff so that, hey, maybe they saved my life. So.
Doctors are the best. Doctors and nurses, these people are really just amazing. And they are real heroes. There's no question about it.
Thank God. So this was a fun little COVID detour. But up next, we're going to talk more with Professor Kotlikoff about whatever his thoughts are on the economy, portfolio construction, money magic tips, and more. This is Josh Jalinski. And folks, call us 888-988-JOSH, 888-988-5674. And you get the free gift, which could be the MaximizeMySocialSecurity.com. Folks, if you have a decision to make on Social Security, it is the best software out there for that. Maxify Planner is one of the best financial planning tools I'm aware of. That's MaxifyPlanner.com. You can buy it yourself or you can get it free when you schedule and keep your no obligation Maxify review. Call us now, 888-988-5674, and go over to Kotlikoff.net and pre-order his book, The Money Magic Book. So, folks, Kotlikoff is spelled Kotlikoff.net. When we return, this is Josh Jalinski, the financial quarterback. Don't touch that dial. And we're back with Professor Kotlikoff. So you were saying, before we got on this COVID detour, where were we?
I think you wanted to talk about cryptocurrency for a bit.
Yes, crypto. And oh yeah, then it was like COVID brain. We got on the, but I'm telling you, man, it's funny. So crypto, what's your take on Bitcoin, crypto, all that stuff? I just thought like that's a sign that the dollar's kind of losing its, like now it used to be like people would want.
No, let me tell you about an interesting dinner I had the other night with the former vice director of the, like vice president of the Swiss Central Bank. This was just like 2 nights ago. And we were talking about Bitcoin and cryptocurrencies, and he said that he feels that he thinks that governments, including the Swiss government, will issue their own digital currency, and that because of the blockchain technology, that if they want to make let's say, transaction with a big Swiss company wants to make a transaction now, they have to go from Swiss francs into dollars and from dollars into yuan, and that in order to, let's say, to get product from China or the other way around, if money's going from China to Switzerland, and he says that's expensive and cumbersome, and that's going to go away, and because the central banks are going to be issuing their own digital currency, and they're just going to be able to swap their digital currency one for one directly without this kind of intermediary, which is the U.S. dollar. So what you were talking about, the hegemony of the U.S. dollar, the dollar being the world's reserve currency, slipping and sliding away through time, I think is true. So I would say to people that plus the fact that we're having inflation should make people aware of the fact that the dollar is likely to lose ground over time. They might want to buy the Canadian dollar, which is pretty weak, but is not likely to. Canada's got a much better managed economy and fiscal system, and central bank in terms of it's got much more control, I think, of its money supply terms of not printing money every two seconds. So buying the the Canadian dollar might be a good hedge against U.S. inflation. It's one idea. But anyway, this is an interesting point of view from somebody in the know.
Yeah, that scares me. When someone in the know backs up what I think, that's like, ooh. Because there's this.
Yeah,
oh, go ahead. Sorry.
I was going to say he doesn't think that the Bitcoin and the private, if you like, digital currencies had much of a future. He was of the view that state-run digital currencies would come into being, and that they would dominate, and that the other, Bitcoin and the other 999 digital currencies that people have floated out there will disappear through time. Let me just give you an analogy. We had during the Great Depression, you'll find this very interesting. I think I found it fascinating. But we had 3,000 different currencies printed by local towns and state governments in the Great Depression. You had towns who were printing money, stamping the back of pieces of bark from trees with some stamp, and they were using that to buy things for the government, and that the bark was circulating as money. So we had like 3,000 different currencies. So the idea that we have 1,000 cryptocurrencies out there, yeah, it can happen because we've seen it happen in the Great Depression, a very similar thing. We saw California when it got into trouble a decade or so ago, in effect, print its own money. It would pay state employees. It couldn't pay them dollars on time, so it paid them orange IOUs, or IOUs on the state of California. It was no different from printing its own money. Now, they were ultimately able to, buy back those IOUs and make good. But, in general, lots of currencies cannot coexist. You really don't need to have a zillion currencies out there in order to do transactions. You just, but you also don't need the dollar.
No, I agree. I sort of think 99% of the cryptos will fall away. I do think probably Bitcoin will remain as sort of the digital gold, if you will, because of the mass. You look at Guggenheim, you look at a company called NYDIG, a lot of these big banks and Wall Street firms are now getting their own Bitcoin funds. Fidelity came up with Fidelity Digital Assets. Isn't that up in Boston by you?
Sure. Mm-hmm.
So I think I do see most of the cryptocurrencies going away and sort of coming what some call the Bitcoin standard, where Bitcoin would almost serve as like a world reserve asset, where you might have like a bank might have 3% of their balance sheet in Bitcoin. And then you might have the CBDC of a particular country. I probably could see a Bitcoin / CBDC world, maybe Ethereum because of the art thing. Although that to me, I don't get 99% of the cryptocurrency world. I've researched only, Bitcoin because it makes sense to me. The others don't. What did he think about Bitcoin? Or he didn't give any? He doesn't think much of it.
Well, I think he thinks these things will ultimately go away, and that the Swiss digital currency and the British Bank of England's digital currency, there'll be enough digital currencies that people have more confidence in, that these other currencies will lose value and it's a highly risky investment. Let's put it that way. The better you should put your money into renovating your home, or buying a car that you can sell in a pinch, or something durable, especially in the context of potential inflation. And I think that we're seeing that. We're seeing durables and house prices going up during the last year or so. So
Yeah, who would have thought my
yeah.
van that I bought
Yeah.
for my 7 kids, right? Bought it for 40 grand, get the taxes and fees, it's 45. Guess how much that van would go for today, Larry?
How much?
69,000.
Oh my God. I'd sell it. Sell it and buy, I don't know, take Ubers.
There
For
you go.
$69,000, you might as well just take Ubers.
Well, no, that would be too
That's a lot.
expensive. My wife carting around the kids to soccer and baseball. and-
$69,000. That's amazing.
I would have bought a fleet. By the way, there was a man in Utah who saw this coming. He bought a fleet of these vans. It's like Tim Dolly Nissan in Utah. The guy bought up every one of these vans that existed in the country.
And now he's selling them.
And
Okay.
it's a discounted van. You know those big old Nissan boxy vans
Yeah.
that are like
Mhm.
massive? They take up, that's us in those vans. So, but thank God we got it when we did, because man, I wouldn't want to spend 60 now. But let's say I sell that van now. I guess I could buy a Ford Transit, but I think they're going for like 55, 60 grand right now. Can you believe that? A Ford Transit. The old work trucks.
Yeah. I think at this point it's not the time to be buying vehicles given their pricing. That they're going to those prices will come back down to something reasonable in a year or two. People should just hang out in their car, in the regular car. It's just too expensive, and probably also the case with housing has gotten pretty dear. So people have to be aware that this is, these kinds of price increases are not going to be permanent.
Yeah, I think the housing market, especially in the Northeast, it boomed because everybody wanted out of New York City, where we are, so they moved to New Jersey. But after a while, people get sick of paying 10 cents on every dollar to the state government. They're moving to Florida. They're moving to Texas. That is a fundamental crisis with state governments. Do they seek you out? Because I know you're sought after by certain people in government. I would love to be part of some council because I love New Jersey. I think if New Jersey had like a 5% state income tax, people wouldn't move, or a 4%. But 10.97 for my company, people, if I moved, the minute my wife says we can move, we're moving. And I'll run my company out of Pennsylvania and drive over, if need be. What, did they seek you out for that? I know you're an economist of some renown, or do they?
Well, I've done consulting and I've talked to state treasurers, and I've had, talked to the Ways and Means Committee of the House of Representatives. They write the tax laws. So I've been around lots of state and federal tax issues, and absolutely we have, in addition to going broke, where we have so many people facing such high disincentives to working. You've got the poor in large part trapped in poverty because they earn money, they lose food stamps, housing support, welfare benefits, Obamacare subsidies, or Medicaid benefits. The list goes on. And then, you've got high income people facing the high, 35% federal bracket, can be 13% in California, and then you've got, we have to remember there's sales taxes in every state that's in effect a tax on working, and a lot of Democrats would like to put the very high earners, people earning over $400,000, have them pay 12.4% more on their payroll, so there'll be like a 70% tax bracket and then they'll stop working and move to a different country. So we have to rationalize the tax system, get the incentives to work down, up, the incentive to work, the net incentive up, the disincentive down, but we also need to get more revenue and we need to cut spending. The federal spending on healthcare, the way it's organized is just, it's not that we shouldn't be giving everybody having health insurance through the federal government, but we have to do it in a way that's affordable. So, Josh, I ran for president. I'll leave you with this because I'm going to have to head off, but I do have a book called You're Hired, which is at Kotlikoff.net, and it's a free download. And, I wrote that. That's as my platform. That's my platform when I ran for president.
Is Biden adopting your platform?
No, I don't think neither Trump nor Biden have read this book.
But even though you were a Biden fan, they didn't come. Did they talk to you after they found out you were supporting him in the election, or not really? Did somebody call you and say, "Hey, we want you to be on our Council of Economic Advisors"?
No, nobody's called. The
hey, at least Trump called you. Didn't they call you from the Trump administration when everything was going to hell? They didn't listen.
I did some. I do have a buddy who was pretty high up in the Trump administration. And I was trying to help with COVID testing.
The testing. They should have listened to you. That was a good prescription. We had you pushing that.
We have these home tests now that the FDA has approved, I think something, or CDC, some like 6 different tests. You can go to the local Walgreens and buy these Abbott Binax Now tests. What the federal government should be doing is using the Defense Procurement Act to make zillions of these home tests and give everybody a year's supply. In Switzerland, you get like a month's supply. You get 5 tests for free every month. But in the U.S., imagine everybody could take for 15 minutes a day, you take a test absolutely free at home. They just put a little swab in you put a little swab in your nose. Doesn't hurt. You don't have to push it up high. And you just see if you're clean, and then
I was a big fan of that a year and a half ago. Nobody bought on to that.
Yeah, but we could get COVID over in a couple weeks if we just got everybody these tests that you can buy in the drugstore, but they're too expensive in the drugstore. So there are so many sensible things we could do and would do if I were president, but unfortunately that didn't happen.
And some are bipartisan. So we'll leave it at that. I know you got to go. Thank you so much for joining us. Anything you want to plug before you go?
I just want to plug your good health and congratulations on the 7 kids, and congratulations on surviving COVID, and stay well.
Yeah,
okay.
Thank God. So thank you for joining us. Kotlikoff.net. And folks, call us now, 888-988-JOSH, and you get your choice of either the Maxify Planner, the Social Security Maximizer tool, or one of Professor Kotlikoff's books. When you schedule and keep your no obligation review, call us today, 888-988-JOSH. And for more of Kotlikoff's work, go to KOTLIKOFF.com. Thanks for joining us. This is Josh Jalinski, the financial quarterback. Oh, final thought?
It's .net, not .com.
.net, Kotlikoff.net. Thanks so much, Larry. Hope to have you on soon. Thanks.
Okay, Josh, you take care.
Bye. Stop the YouTube.
Thank you.
Okay, guys.
Thank you.
Enjoy your time.
Have fun in Europe.
Okay.
Have fun in Europe. Thank you.
Wish I was there.
All right. Take care, everybody.
Bye-bye.
Goodbye.